A single trade, a $2.4 billion bet against the market, placed by the most powerful bank on Wall Street. This is not normal investing. This is a trigger waiting to be pulled. And the target is not what you think. The mechanics are already in motion. The same fragile market structure, the same explosive social dynamics that created the GameStop phenomenon. They never left. They just moved up the chain. And now, they are pointed directly at the heart of the system. What happens when the hunter becomes the hunted? Welcome to everyone watching, wherever you are in the world. To the seasoned observers in London, the late-night analysts in Singapore, and the strategic minds across North America, welcome to Wild East Stories. I am Marcus. From my study overlooking the old financial district, I map the fault lines in global capital. I do not trade on hype. I analyze the undercurrents that move empires and break them. Today's story is a briefing, a strategic warning disguised as a headline. If you are a business owner, an entrepreneur safeguarding your capital, or simply someone who understands that the real stories are written in ledger books, you need to see this through. So, if you're over 50, you've seen cycles of fear and greed before. Do not click away. What's coming requires your wisdom. Subscribe to the channel. Fortify your knowledge. The past is about to speak very loudly. And for all of you, tell me in the comments, from which city are you watching this analysis? Your perspective is part of the map. A financial tremor begins with a single, deliberate pressure point. In early 2024, regulatory filings and data from market intelligence firms revealed a startling position. JPMorgan Chase & Company, the colossal and typically conservative pillar of American finance, held a public short position valued at approximately $2.4 billion. The number itself is almost too large to visualize. It is not merely a trade, it is a statement. But in the complex language of modern finance, statements can be misunderstood. The first task is to decode what this actually means. The term short is simple in theory. An investor borrows an asset and sells it, hoping to buy it back later at a lower price, return the borrowed shares, and pocket the difference. It is a bet on decline. However, at the scale of $2.4 billion executed by a systemically important bank, SIB, simplicity vanishes. This is not necessarily a reckless gamble. For a bank like JPMorgan, such a massive directional bet could serve multiple strategic purposes. It could be a hedge, an insurance policy, offsetting risk elsewhere in their vast, global portfolio of loans, derivatives, and investments. It could be a proprietary trade, where the bank's own capital is at risk based on its economic outlook. Or, most intriguingly, it could be a facilitation trade for a major, anonymous client, placing JPMorgan in the middle as the counterparty. The critical vulnerability lies not in the why, but in the what and how. The target of this massive short, while not explicitly named in the headline, possesses specific, dangerous characteristics. Through analysis of public data and market patterns, a profile emerges. The target security has a relatively small float, the number of shares actually available to trade publicly. It is likely already a subject of intense discussion in online forums, meaning its investor base is a mix of dedicated long-term holders and a volatile, passionate community of retail investors. Most importantly, it is woven into a dense web of derivatives, specifically options contracts. This combination is flammable. A large short position against a small float creates a mathematical time bomb. To eventually close the short, JPMorgan or its client must buy back every single borrowed share in the market. If the available shares are scarce because the float is small and other investors refuse to sell, the act of buying to cover can itself drive the price violently higher. This is the basic engine of a short squeeze. It is supply and demand in its purest, most brutal form. But the year is not 1990. The market infrastructure today adds rocket fuel to this basic engine. This is where the ghost of GameStop returns. The $2.4 billion short does not exist in a vacuum. It is surrounded by a galaxy of call options, bets that the target's price will rise. Market makers who sell these call options must stay delta neutral. To hedge their risk, they buy the underlying stock. When the stock price starts to rise, even slightly, these market makers must buy more stock to rebalance their hedge. This forced, automated buying pushes the price up further, which forces more hedging purchases. This self-reinforcing loop is called a gamma squeeze. It is an accelerant on an already burning fire. Thus, the catalyst is not just the short. It is the short's existence within a specific, fragile ecosystem. JP Morgan's $2.4 billion bet is a boulder placed on thin ice. The weight alone is a danger. But the real peril comes from the invisible network of cracks already spreading beneath it, the small float, the simmering retail interest, the tangled web of options. The first sign of upward price movement, from any catalyst, does not just signal a losing trade. It risks triggering a chain reaction of automated buying and frenzied covering that could escalate with shocking speed. The market, in this setup, is no longer a place for discovery. It becomes a machine for explosive reflexivity. This is the anatomy of the modern catalyst. It is a fusion of old-fashioned leverage and new-age market structure. The stage is now set. The players have taken their positions. One of the most powerful banks in the world has, perhaps unintentionally, placed itself at the center of a perfect financial storm. The only missing element is the spark. To understand the future, one must reverse engineer the past. The GameStop event of 2021 was not an anomaly. It was a diagnostic, a stress test of the modern market's hidden wiring, revealing flaws that were never fixed, only forgotten by those in power. For the business strategist, it serves not as a meme, but as a master blueprint, a detailed schematic of how a seemingly trivial stock can become a black hole, sucking in billions and warping the rules of finance. The narrative of dumb money versus Wall Street was a compelling story, but it was not the true story. The true story was one of catastrophic market structure failure. At its core, the GameStop squeeze was a mechanistic inevitability, not a revolution. In the months leading to January 2021, short sellers had bet against the company to an unprecedented degree. Short interest exceeded 140% of the company's available float. This was the first critical error, a bet so large it became a physical impossibility to unwind without moving the price catastrophically. The short sellers were not just betting on a company's failure. They had sold more shares than actually existed. This created a trapped obligation. Every single shorted share had to be bought back. The market for those shares was finite. When a dispersed crowd of retail investors, coordinated on forums like Reddit's Wall Street Bets, began buying shares, and, more importantly, out-of-the-money call options, they did not just express a bullish opinion. They flipped a switch in the market's plumbing. Here is where the ghost entered the machine, the options market makers. These are the silent, automated engines of liquidity. When a retail trader buys a call option from a brokerage, a market maker on the other side typically sells it. To remain neutral to risk, the market maker must instantly buy a certain amount of the underlying GameStop stock. This is delta hedging. It is a robotic, non-discretionary process. As more call options were bought, market makers were forced to buy more stock. This buying pressure pushed GME's stock price higher. A rising stock price increased the delta of those call options, forcing the machines to buy even more stock the next day to re-hedge. This created a self-fueling feedback loop. Rising price triggered forced buying, which triggered a higher price. This was the gamma squeeze, accelerating the basic short squeeze into a vertical spike. The violent price rise became a margin call for the short sellers. To meet their soaring losses, they were forced to buy back shares at any price, pouring gasoline on the gamma squeeze. For a few days, the system turned inside out. The flow of capital reversed. The predictable hierarchy, where institutions set prices and retail investors followed, shattered. The aftermath was a landscape of lessons, most of them unheeded by the core system. Regulators focused on the symptoms, trading halts, brokerage restrictions, not the disease. The disease was the asymmetry of liquidity in a digital age. A small float stock, buried under an unsustainable level of short interest, had become a nuclear reactor. The social media community did not create the reaction. They merely inserted the control rods, initiating the chain reaction that the institutions themselves had built. For JPMorgan's $2.4 billion short, the GameStop blueprint is a chilling precedent. It proves three non-negotiable truths to the analytical mind. Mathematical limits are real. A short position that is too large for the available liquidity is not a trade. It is a structural vulnerability. Derivatives are amplifiers, not just hedges. The options market is not a separate arena. It is a lever attached to the core market, capable of exerting force orders of magnitude greater than the initial pull. Social coordination is now a market force. Information velocity has changed. A decentralized network can identify and exploit a structural weakness faster than a traditional institution can defend it. The ghost of GameStop is not confined to 2021. It is embedded in the code. It waits in the infrastructure. The players at JPMorgan and their counterparts know this history. They have modeled it. Yet, the $2.4 billion position exists. This suggests either a calculated belief that their target is immune or a fatal underestimation of how the blueprint has been studied, shared, and is now waiting to be executed again on a grander stage. The financial landscape has shifted. The GameStop blueprint revealed the playbook, but the battlefield itself has been radically transformed in the quiet years since. We are no longer looking at a repeat. We are analyzing an escalation. The confrontation is no longer between dumb money and smart money. It is between a highly centralized, leveraged position and a decentralized, intelligence-gathering network. This is asymmetric financial warfare, and the terrain uniquely favors the insurgents. The first and most critical change in the terrain is liquidity fragility. Post-2008 regulations made banks safer, but had an unintended consequence. They reduced the willingness of major dealers to hold large inventories of stocks and bonds. This market-making capacity acts as a shock absorber. Simultaneously, the meteoric rise of passive investing, index funds, and ETFs means trillions of dollars now move in blind, automated flows. The result is a market that is deep but brittle. It can handle steady volumes, but during a crisis, the traditional shock absorbers are gone. Liquidity can vanish in seconds, turning an orderly retreat into a panic. For a $2.4 billion short position, this means the exit door is narrower than the models likely assume. The second transformation is in the web of derivatives. It has grown denser, more complex, and more interconnected. The target of JPMorgan's short is not just a stock. It is the center of a financial spiderweb. Each strand is a contract: options, total return swaps, exchange-traded funds, ETFs, that must replicate its holdings. A move in the stock price does not just affect the short seller. It triggers automatic, non-discretionary responses across this entire web. Hedge funds might be short via swaps arranged by other banks. ETFs must rebalance. But the most potent strand remains the options chain. The concentration of open call options at specific strike prices creates not just one potential gamma squeeze point, but a series of explosive tripwires. The market is a minefield, and the map is publicly available for anyone to study. This leads to the third and decisive shift, the intelligence gap. Institutional capital operates with sophisticated quantitative models, algorithms that process decades of historical data. But these models are backward-looking. They are designed for the previous war. They struggle to price in a new variable, the synchronous behavior of a digitally networked crowd. This crowd is not an emotional mob. It is a distributed research collective. It uses sophisticated retail platforms, forensic accounting, and real-time data scraping to perform what was once the sole domain of hedge fund analysts, identifying structural vulnerabilities. They are not trading on fundamentals alone. They are trading on market structure flaws. They see the $2.4 billion short, the small float, and the dense options chain not as disparate data points, but as a single, targetable system. Their weapon is coordination, and their battlefield is transparency. Every regulatory filing, every options volume spike is dissected and broadcast in real time. JPMorgan, for all its capital and intelligence, is fighting on this new terrain. Its position is central, visible, and massive, a classic disadvantage in asymmetric conflict. Its opponents are dispersed, nimble, and can attack from 1,000 directions, through shares, weekly call options, other correlated assets. The institution is bound by risk limits, compliance rules, and quarterly reporting. The network is bound only by conviction and capital availability. This creates a profound strategic inversion. In traditional finance, size equals power. On this new battlefield, size can equal vulnerability. A large position creates a predictable point of failure for others to exploit. The network's goal is not to outspend JPMorgan, but to trigger the market's own automated machinery. the gamma squeeze, the margin calls, to do the work for them. They aim to spark a chain reaction within the system that the system itself cannot control. Therefore, the question is no longer if the mechanisms for a squeeze exist. They do. The question is one of trigger discipline and catalyst timing. The network crowd is patient. They can watch and wait for the precise moment. An earnings surprise, a strategic announcement, a covering of a smaller short position by another fund, that provides the initial spark. In this environment, any piece of positive news is not merely news, it is potential ordnance. A single trade unraveling is a loss. A trade of systemic importance unraveling in the new asymmetric battlefield is a contagion event. The true danger of the $2.4 billion short position is not contained within its own ledger entry. It exists in its connections. Like a fault line, the pressure is local, but the quake travels. If the spark ignites the gamma squeeze, the fire will not stay in one house. It will race through the interconnected neighborhood of global finance, following the paths of modern leverage and panic. The first and most immediate domino is counterparty risk. JPMorgan is not an island. Its trade involves other entities. Who is on the other side? It could be a handful of large hedge funds who took the opposite view, or a complex web of intermediaries. If the squeeze forces JPMorgan or its client to cover at catastrophic losses, the entities on the winning side of that trade face a sudden, massive inflow of capital. But more critically, the losing side may face extinction-level margin calls. This could force the rapid, disorderly liquidation of that firm's other holdings, assets completely unrelated to the initial short. Blue-chip stocks, corporate bonds, foreign currencies could be sold indiscriminately to raise cash. This is how a localized fire creates its own wind, spreading embers to other markets. The second domino involves the derivative web. As previously established, the target stock is a node in a network. A violent upward price spike would devastate anyone with a short exposure via options or swaps. But it would also create a parallel crisis for volatility sellers. A whole class of institutional strategies, run by massive hedge funds and banks, profit from calm, stable markets. They systematically sell insurance against big swings through complex instruments like volatility swaps. A vertical, GameStop-like explosion in a single stock, especially one tied to a major index, would shatter that calm. It would trigger monumental losses for these volatility selling strategies, forcing them to liquidate positions across the entire market to cover their own broken hedges. The shock transmits from a single stock to the very fabric of market stability. The third domino is regulatory and reputational earthquake. JPMorgan Chase is not just a bank. It is a primary dealer, a pillar of the U.S. financial system. For it to be caught at the center of a destabilizing squeeze event would trigger an unprecedented crisis of confidence. Legislators would demand immediate hearings. Regulators would be forced to act, not with the deliberate pace of rulemaking, but with emergency interventions. The likely target? The very tools that enabled the trade, short selling and options trading. We could see sudden, harsh restrictions on short interest levels, margin requirements for options, or even temporary bans. While aimed at stability, such knee-jerk rules would freeze legitimate hedging and price discovery, creating a new layer of uncertainty. The reputational damage to the bank and the cloud it casts over all institutional risk-taking would linger for years. This leads to the final and most perilous domino, the moral hazard dilemma. At the peak of the crisis, would the Federal Reserve or the Treasury step in? Imagine the scenario. Losses are spiraling, threatening the solvency of a major hedge fund or the stability of a key market segment. Would authorities allow a free market correction to run its course, even if it risked a broader credit freeze? Or would they intervene, perhaps by facilitating liquidity to the strained institutions, effectively bailing out the losing side of a speculative trade? This is the system's ultimate trap. Intervention teaches the market that the largest players are protected, encouraging more reckless positioning in the future. A textbook moral hazard. Non-intervention risks a crisis of confidence that spirals beyond the original trade. It is a choice between validating the network's attack on the system or validating the system's inherent unfairness. Neither outcome strengthens the market's integrity. Both erode trust. Therefore, the squeeze is no longer just a trading phenomenon. It is a cascade. It moves from a single position to related firms and asset classes, to the regulatory and trust framework, and finally, to the core philosophical foundations of the market itself, domino 4. The $2.4 billion is not just a number on a screen. It is a weight placed on a precisely balanced series of pillars. If it falls, the architecture shakes. The financial community must look past the headline drama of a winning trade and see the structural aftershocks. The real cost is never just the loss on the trade. It is the broken trust, the punitive regulations, and the paralyzed capital that follow in its wake. The wildfire, once started, chooses its own path. The analysis is complete. The catalyst is identified. The blueprint is understood. The battlefield is mapped. The contagion risk is acknowledged. This is not a prediction of doom, but a diagnosis of a new condition. The financial ecosystem has entered the age of reflexive finance, where prices do not merely reflect value, but can actively distort the underlying reality through feedback loops of leverage, derivatives, and decentralized coordination. For the business leader, the entrepreneur, and the steward of capital, the historical cycle of simple boom and bust is over. The new cycle is one of structural asymmetry, where small pressures in the wrong place can trigger disproportionate, systemic shocks. The imperative now is not prediction, but preparation. Here is the strategic framework for navigation. For the portfolio manager and institutional investor, the lesson is to stress test for narrative risk and gamma exposure, not just volatility. Traditional models ask, what if the company misses earnings? The new model must ask, what if our position, or a major counterparty's position, becomes the narrative focus of a decentralized network? This requires forensic transparency on short interest, options chain density, and float liquidity for every major holding. Hedges must be scrutinized. A short position intended as a hedge could itself become the primary source of risk if it is too large for the market to digest. Diversification remains key, but it must be diversification across market structure profiles, not just sectors. Allocating a portion of capital to extreme, non-consensus scenarios, like a major gamma squeeze, is no longer speculative. It is prudent insurance against a reflexive world. For the corporate executive and board member, your company's stock is no longer just a currency for acquisition or a scorecard for performance. It is a potential vector for systemic risk. Executives must understand their company's squeeze profile, its public float, the concentration of its ownership, and the volume of options traded on its shares. A company with a small float and a passionate retail investor base is operating in a different financial reality than a widely held megacap. This has direct implications for corporate actions. A share buyback program, for instance, could unintentionally reduce the float to a critically low level, making the stock a target. Investor relations must evolve beyond quarterly calls to include monitoring of social sentiment and market structure data. Your defense is awareness and proactive communication. For the aspiring entrepreneur and analyst, see this moment as the great reveal. The GameStop saga and the potential JPMorgan sequence are not distractions from real business. They are masterclasses in complex systems theory. They demonstrate that the market is not a perfect machine, but a complex adaptive system, vulnerable to phase transitions. The skill of the future is not just discounted cash flow analysis. It is network analysis. It is the ability to map connections, identify single points of failure, and foresee how information and capital will flow through a network under stress. This is the new literacy. The entrepreneur who understands these dynamics can better time capital raises, identify undervalued assets trapped in structural complexities, and build businesses resilient to financial shocks. The final synthesis, a system transformed. The warning embedded in the title, "It's starting," is correct, but its scope is broader than a single squeeze. What is starting is the final assimilation of a permanent truth. The market's infrastructure is now a participatory narrative. The power to define reality, at least for a time, has partially shifted from centralized institutions to decentralized networks. The $2.4 billion short is a symbol of the old world, large, centralized, and confident in its models. The reaction it may provoke is a symbol of the new, agile, distributed, and weaponizing the system's own plumbing. This is not a call to fear. It is a call to strategic clarity. The reflexive age does not eliminate opportunity, it redefines it. It rewards those who study pressure points over popularity, who value robustness over mere returns, and who understand that in an interconnected system, the deepest risk is often the one you facilitate unknowingly.